Welcome to a special edition of the Salty Investors. Today we've got Larry Jamieson, and he's from Buyback Capital. And I've been following his work on his website and YouTube channel. Some really good information about markets and especially quality companies. And on Twitter, you can follow him, and he's got over 7,000 followers there, so that's really good. Yeah, and I'm just impressed to have him because he's under 30 as well. Who would have thought someone with this sort of knowledge would be under 30? But here we go. And yeah, I just want to get right into it and just want to get a bit of a background and how did you sort of come to this understanding in your financial knowledge, Larry?
Thanks, Tim. Thanks for having me on. Yeah, sure. So, we were talking a little bit before, but my dad was a real estate developer and a business owner around Queensland and in New South Wales as well. And so, from a very early stage, he's always talking about the stock market and real estate deals and stuff like that. So that was kind of a staple in the household. And so I can remember, when I was like in high school or something like that, Dad mentioned Berkshire Hathaway to me, and I remember it was around about the time we were doing I don't know if you did this, but the share market trading game
Oh,
where
yeah, yeah.
you do that 8 weeks, yeah. And he's like, oh, you should check out this company over in the United States, and I saw that the share price was like 80, $90,000 at the time, and usually you don't see share prices that high, so I was really like,
Hmm.
I was like, wow. Um, but yeah, so ever since a young age, I've had a bit of an interest in this. During uni, I think a lot of people save up a few $1,000 and they punt CFDs, and
Yep.
yeah, I did a bit of that, and the
Oh, okay.
yeah
Yeah, yeah, yeah.
the long short equity and the global macro kind of approach. And a bit later on, I got pretty interested in complex option spreads on the broad-based indexes and the index futures over in the States. And my dad and some of my family put in some money for that, and we did pretty well. But it never really made sense to me, like why. Like where the returns were being generated from, like momentum or back-tested strategies or any of that kind of stuff. I could never have conviction in why this was going to be a kind of long-term strategy that could generate returns. And then in about 2018, 19, I found like Manish Prabhai on
Okay.
YouTube, and
Yep.
kind of a bit of a renaissance in the YouTube finance community that had all these great interviews coming out, and like the good investing guy, and all this
Yep.
good stuff. And so it was kind of like a value renaissance for me. And then yeah, I've
Hmm.
just kind of been um, trying to manage my own money in a kind of Buffett-esque type way, if you will,
Yep.
um, ever since. So that's kind of my short journey.
So who do you sort of follow in this sort of area now? Who do you respect and, you know, who do you look up to as like an investor that you can that's giving alpha, not like, yeah, obviously Buffett, but obviously someone outside that as well. Hopefully, there's someone you sort of like that people would know, I guess.
Yeah, sure. So I think like just like you said, it's pretty trite, but
Hmm.
um, Buffett and Munger are obviously like the cornerstone. There's been some interesting other people that probably in the last 2 or 3 years, like their investor letters have come to light, and you've been able to, like, I
Oh yeah.
remember looking for Nick Sleep's letters like 4 or 5 years ago, and you could never find them. And
Hmm.
there were like threads on Wall Street Oasis being like, "Has anyone got a copy of
Yeah,
this?"
yeah, yeah.
And just couldn't find it. But I didn't mind Nick Sleep's letters; they were good. Rob Vinal of RV Capital, he
Hmm.
puts all his stuff. He's in
Yep.
investor meeting, and he's done a few good interviews as well. I really liked him. I think you're a Terry Smith
Yes.
kind of guy. Yeah.
Uh,
Like Terry.
okay.
Um,
Yeah.
and the Sequoia Fund, they put out some quarterly
Okay.
um, recordings and stuff like that, and and I've had a lot of crossover in the type of companies that I've liked, and the kind of companies that they've invested in as well. So kind of like that. And there's a great guy called Dev Kantasaria, and he hasn't done many interviews. I think he's got a couple of interviews on YouTube, and
Okay.
I did a few like CNBC appearances, and he's like a Buffett quality purist in the true sense of the word, and I really enjoyed his stuff too.
Okay. Oh, that's interesting. Yeah, I'm in a similar type field, but obviously, everybody's got their own little areas that they stick into. But so, what sort of metrics and qualitative and quantitative are you sort of looking for in a company nowadays? Like, obviously, it's evolved over the years. I can't imagine you doing nets and things like that, but maybe I don't know. What are you into at the moment, and what are you sort of looking for in a company when you're trying to purchase something here and sell something?
Yeah, sure. I think we had a bit of a yeah, you had a bit of a look at the checklist that I put on my blog, and I probably should update that now because like over the last probably 18 months, I've really been trying to refine down the parameters um, that I'd be looking for in a company that I want to invest in. So I think we've had probably a bit of crossover in terms of like Facebook, or maybe a bit of a position in Alibaba, or I think you said Redbubble as well. I think we're both in the Redbubble sin bin.
Yeah, it's a bit
um,
bit nasty that one, but hmm
yeah, and that was a great learning
hmm
opportunity for me. I feel like a probably like if you make a few of those mistakes earlier on, that might save you a lot of money later on.
yeah. I'm
Um,
chalking that one up. Yep.
Um, yeah, but I mean, really, the two types of things, and Buffett talks about this a lot, is um, the first vector that makes a really great business, the fabulous business, is a pricing power,
hmm
and naturally the second type of thing you'd want to look for is volume growth, and those things can be obscured, they can be coming online, there can be there's never there are very few companies where both pricing power and volumes are just
Yeah.
up and to the right every year. So
Uh-huh.
there's different, although there are some companies like that, and I think you might be a fan of FICO. They're a good
Yeah.
example of someone who's doing pretty well on both of those accounts. But that's the type of thing, and those two qualities really lead into um, a lot of the characteristics that people look for, which would be high return on tangible equity and high return
hmm
on assets, and um, obviously in a situation like that, those are companies that generate a lot of excess cash, and some portion of that cash can be redeployed within the business, usually some amount of
Okay.
cash.
Yep.
um, yeah, like in the sort of Coca-Cola type investments, or Gillette, that Buffett did in the past. He would usually say there's some amount of cash that they can reinvest into the business, but the reinvestment opportunity was not unlimited. So they'd
hmm
have a lot of excess cash, and then you're trying to figure out what management's going to do, and sometimes management doesn't do what you want them to do with the cash.
Yep.
Um, and so, that's where the capital allocation piece, and that's where management's really important. The companies that I would like to invest more in would not actually need probably incredibly talented management. The management would need to have integrity and a reasonable capital allocation framework.
Yep.
But we're kind of looking for the great business qualities to be institutionalized, not they don't
Mm.
need Buffett or
Yes.
Jobs or someone like that to really turn this
hmm
from 0 to 1.
Yeah. But obviously,
So I guess
obviously
that
that,
kind
that they're a little bit expensive, these companies. So like you're not going to pick these ever up cheap. You're not. These are always going to be. The market sees this as well. So how are you sort of balancing that? The quality versus the the valuation type metric that you're trying to get in here. How do you sort of balance those two?
Yeah, and that's like the whole game, isn't it? So I guess on the buy decisions, you're looking for you might look for these qualities, and it might take you, and usually what I found is following them for a decent period of time, after you've heard it. So you hear about the company, you have a look, and you might think, oh, this actually looks quite interesting.
Yep.
And then you follow it for 6 months, a year, whatever it is. I won't say I've followed things for multiple years because that'll push me back, maybe back before I was taking this very seriously. But um, you are looking for those qualities, and then you're looking for you're looking for value in the future. So like if we take the FICO example, which I'm a pretty big fan of, in 2000, you could have purchased that company for 50 times forward earnings. And if you'd held that from the peak of the sort of 2000 top till now, you'd probably compounded your money in the high teens, which would have been a perfectly good result.
Yes.
You would have had some pretty nasty drawdowns in that time period, but you also, the long-term returns of the company were pretty good, and the bottom line is that the value is in the future.
Yes.
And you know, it's pretty well known, or relatively well known now, that in 2018 that company had a step change in its pricing power, so it renegotiated the special pricing contracts with the credit bureaus, which essentially until amount of economic goodwill in their product, and it wasn't being monetized.
Yep.
And so over time, the new management were able to chuck on the pricing power. And then I didn't even know that they had CPI plus special pricing. So like, you know, that's why you've seen the kind of huge run up in the company this year, because that was quite underappreciated as well. And then, you know, they can also take those earnings and, you know, lever up the balance sheet and then repurchase a tremendous amount of shares, even at what would be a very high valuation. So the point there is really trying to print out you know, these kind of extra normal growths in operating income or free cash flow per share or earnings per share over a multi-year period. And if you go on to if you look at consensus earnings for some of these companies, usually the analysts will put a consensus, you know, EPS number or revenue numbers, et cetera, out for the next 5 years. And most of the time, the analysts will assume that the company will return to normal growth, you know, maybe GDP or GDP plus a few percent after that. And, you know, the reason why Moody's has done so well over the same years in the same veins is that it kept up this extraordinary free cash flow EPS growth for like 10 years after 10 years. And you could have paid, you know, because when Moody's was spun out of, I forget the company now, it was spun out in the early 2000s. And you can read a Value Investors Club write up on the spin out. And so it would have been an excellent time to buy. And the first comment was, how can you justify buying this at 33 times forward earnings?
Yes.
And that's the whole answer. If you had known that there was going to be this incredible value creation over a multi-decade period, even with the worst blow up in the industry ever, like they were essentially selling poison product in 2008 and 9. Yep. And they would just keep going despite that. And that was even maybe even like a catalyzing period for them, because they got out of a whole lot of poor returning elements of their business. So I would say that's the first element. Like sometimes you'll find a business that is just excellent, and if you can have a lot of conviction that they will create a lot of value in the future, that can be an opportunity. And you'll get downdrafts. So like plenty of people on Twitter thought this, and on Value Investors Club too, thought the shares were interesting in November 2021, and then I think it was like the April or the June of 2022, it got down to $350 a share, and that turned out to be 17 times forward free cash flow per share, which that's a pretty good deal because they've been growing. And like the special pricing element, right? You can see that going for a long time, like a long time. The average score pool. So if you just take their revenue and you divide it by how many scores they return in a given year, it's something like $13. The company says it's more like $7. So there's a bit of a discrepancy there. I feel like on some mortgage score pools, they may be charging like hundreds of dollars. So I don't want to get to the weeds there, but it's like $13 on closing costs of $3,000 on a mortgage of $500,000.
Yeah.
That could go on for quite some time. And so, you know, you can get a bit of conviction there that this company may have, you know, maybe mid-20s free cash flow per share growth on a very, you know, bullish assumption. On a low-end assumption, you might get special pricing of, you know, 10, and you might get CPI, and maybe the new CPI is 4. and they retired 10% of their shares last year. And so
I
that is a
know.
number that gets you to 24%. And
Yeah.
maybe they can't repurchase 10% of the shares every year,
Yeah,
but
yeah, yeah.
maybe it's five, and 19 is still a perfectly good number. And then on the other end of the spectrum, because I know you've had a look at the portfolio, and I've invested in credit acceptance since the end
Yeah.
of 2020, which has been a very amusing ride. But the bottom line with that company is that it's yeah I uh, X of the extrinsic legal risks that face the
Mhm.
company at any time. It's traded at a remarkably low valuation, um, and they just retire so many shares. And the company is the reason why the investment will work, if it does work, is because they are simply able to return a tremendous amount of cash to the shareholders because the price is so low. And so in that instance, it would be like a price is its own
Okay. So
price
that's
is
what
its
you
own
see.
catalyst.
Uh-huh.
Like if you take the end of 2020, and this is when the Massachusetts Attorney General's case came out. It was a big thing at the time, and the shares were off like 30% in one day. Um, the company now, even though the share price is higher, the per share price is higher today. The market cap was higher then,
Okay.
and that just kind of shows you, like, if they produce the cash and they return it to you, like
Well,
that's a
well, bad
fairly
news.
big delta.
It's
Yeah.
pretty good for the long term. If they buy them back at a lower price, you're sort of you're retiring at a lower price. That's what you want to do over a long period of time. You want them to retire at a low PE if you possibly can, and then just keep compiling. So
So long as the business gets better over a kind of fight, or even stays the same. I mean, NVR is a good
yes,
example of
yeah.
that. NVR was a business that,
AutoZone,
you know,
another classic. Yes, exactly the
they're
same
fair,
book. Yeah.
they're fairly stable. The EPS growth has largely come from a levered buyback program. Um, Obviously, in AutoZone's case, they actually had quite a bit of expansion, but in an NVR, they've had some expansion too. But
Mm-hmm.
like in this whole period, they had the worst catastrophe in US housing right in the middle, and
Yep.
tremendous value creation. So, British American Tobacco or the tobacco companies might fall into a thing like this, where literally the price is so low that the capital being returned is you'll get your return from capital being returned to shareholders.
It's just a lot tougher, like compared to your other investments, it's just a very, you got to keep your eye on the ball here and watch it closely. Well, FICO, if I went to sleep for 10 years, I wouldn't care at all. But, I know you're a bit younger and you can handle a little bit more and you've got a bit of a background in this sort of area, so you can handle a little bit more pain. But yeah, it's just might be good to balance it as well. Like, yeah, you got a bit of value there as well. So I'm not
I,
sure
I,
if
I
that's part of
definitely Yeah, I definitely think I would not invest in a credit acceptance again, even though I do think it's a wonderful company. And I think generally lending businesses are not uh, they probably go broke at some point, even though they probably have periods of extraordinary returns, and credit acceptance at 50 years, without a
Okay.
bankruptcy. It's
Yes.
a remarkable achievement for what for what they've done. But I mean, Buffett only really invests in lending institutions that are banks, and he does that because they're FDIC insured, and there's no chance of him losing money.
Yeah. And he has got a float, he's playing with a little bit more money than you. So, a bit hard to play in this area for us normal mortals. So how do you sort of structure your portfolio? And do you ever go, oh yeah, I've got a special situation, I'm going to jump out of this discipline and go after, like I went after barber, thinking I'm a smart ass here and falling knives and, it's coming back a little bit, but, it's hurt me a little bit. But do you ever jump out of your sort of discipline here, or are you going to keep a bit more of a rigid discipline going forward? What are your thoughts?
Um, yeah, so I really want to just be a quality purist. That's
Okay.
um, and the FICO end of quality, if you will. So
Oh,
like FICO is or even a VeriSign, a Moody's, something like that. They're probably as close to perfection as you're going to get. Like if you're gonna say like what's the perfect company, it would be a company that has one employee who's the CEO and it has some intangible quality that gets distributed magically, right? And
Hmm.
every year people want more of it, and every year you can raise pricing CPI plus 15, and
Yep.
every year all of the cash is put into a levered buyback, and like there are no expenses, and the CEO has like his whole net worth in the company, and so like that's like you're pretty close. That's probably as
Hmm.
close as you're going to get. I mean, Verisign's a good example. Obviously, it
Yeah.
doesn't have the extreme pricing power, but
Hmm.
that's kind of where I want to get more to, and that's where Buffett made a lot of his
Yes.
very large money in places like that. I do have a fairly large position in Amazon as well, and so I'm partial to the complex vertically integrated monopoly.
Hmm.
I think you need to have a pretty high barrier
Hmm.
for quality on that end. You need to have a handle on the durability. I have invested in like deep value situations before. So
Okay.
through COVID, I owned a couple of Canadian E&Ps, and they were sitting on like proven gas reserves of maybe 6 times the share price. Um,
Okay. Wow.
and yeah, and some of these existed in 2019. Incidentally, you could have had a look around the United States, and like the gas and petroleum
Oh yeah.
E&Ps like
Hated with a
absurdly cheap.
passion. Yeah, hated with a
Oh,
passion. So,
you've seen the share price. It's just like since 2014, just straight down,
yep.
year after year after year after year. Um, and so
Hmm.
like you could have just put like a basket bet on some of those, and you would have done perfectly
Yes.
well. So I've done a bit of that. It's not that interesting to me. I'm not that interested in spin-offs or special
Okay.
sits or like Charlie Munger says, like the biggest win in investing is the person who uh, figures out the future and then gets rich sitting on his ass. So that
Uh,
would be my preferred mode of wealth generation. There's nothing wrong with the net nets or something like that. I think it's a lot more active approach to investing, and
yep.
um, perhaps you need to like in law school. I hated all the reading. Like I just was not like the minute detail. I just wasn't for me.
Okay.
I don't work in the law. I wasn't that successful as it. But that kind of approach does not um,
Yep.
really
Well,
suit my personality.
stick with the winners, mate. That's what I'm sort of thinking a bit now. And, and got this momentum thing, that factor investing, if you understand any of that, you sort of go, oh, what's this thing going on here? And, like there's a couple of advantages, in this type of thinking, but you got to get it right. If you get it wrong, you're in a world of pain. So, yeah. So just wondering, does macro at all fit into your sort of discipline here, or you sort of, you know, a purist, you said, and you're not supposed to be looking at macro, but I sort of, I do factor it in a little bit. There's a time to play. If you only got a little bit of money, you've got to tranche it in. You know, here a little bit. You can't just willy-nilly go in all the time. So yeah, what do you sort of think on macro, or you don't play it at all, or what do you think? What are you thinking here?
Think Yeah, I think macro is very interesting, but macro forecasting is, in my experience, it's the purpose of it is to make fortune tellers look good. So I
Yeah.
think it's very interesting. It's great to chat about, and like everyone in Australia likes to, the national pastime is speculating on what the RBA is going to do next, and
Uh-huh.
what residential house prices are going to be like, and that's all good fun and stuff like that. I don't think it's that I haven't found it that useful
Okay.
um, in in investing, and in any case, I'm probably not good at forecasting it. And the real thing we're trying to keep our eye on in investing is trying to buy future cash flows at
Yeah.
the lowest possible price that we can. Um, so be my general. I think it's very useful to think about what might happen. So um, you can definitely come to a pretty good understanding of what will happen in the future. The hard part is just when.
Hmm.
And so when you're underwriting risks in the shares that you own, um, it's probably good to look back in history and say, and this might be different from industry, but it's quite interesting to say, oh, what happened to credit volumes in 2008 and
Yes.
9? What
Hmm.
happened to this business in 2008 and 9? Or, there was a large, I think there was a large retail recession in Australia in 2014. like a lot of the shares peaked then and they sort of came off. And
Hmm.
or if you're an energy investor or something, that'd be very interesting to see what happened to businesses post 2014 when the sort of they were saying the super cycle was ending, but
Yeah.
kind of come back now. So I think that would be very informative as a historical,
Okay.
exercise to check out that, but it doesn't really. Not I'm not trying to use macro as an entry point,
Okay.
if you will.
So you're not keeping any cash and you're fully invested? You'd like to keep it that way? Because, like we've had 30 years of interest rates only going in one direction, and you think, well, multiples might get a little bit of compression here at some stage. I don't know, it could be all talk. So what are you thinking?
Yeah, it's a really good question. I think if you're focused on companies that can, and I'm not a big fan of inorganic growth. I think that can be um, helpful at various points because maybe you can make a bolt-on acquisition here and there. But I generally
Hmm.
think the people who have made their fortune through very large roll-ups are probably either madmen or geniuses, and there are very few geniuses.
Yeah.
Uh, so if you're focused on companies that are generating a lot of cash. And they have good reinvestment opportunities and good capital allocation structures, and they can grow their, EPS and free cash flow per share by when it's all factored in, high teens or maybe even low 20s, and you've
Hmm.
got a long runway in front of you there, that will overcome a lot of multiple contraction.
Okay.
So really, you want to be very sure about the business.
Hmm.
And then the lack of business risk and its strong financial performance will probably be the best shield you'll have against declining share values or perhaps even a declining economy. If you can find businesses that are not acyclical, but strong secular growth and
Hmm. Yes.
don't tend to be levered to the business cycle, that's probably one of the better places you can hang out.
Oh yeah, you're speaking like Terry Smith. I think you'd get along with him very well. That's what he talks exactly. But he knows he's going to get a little bit of hurt here, coming into it. So, but if you can look through that, you've got that quality business, it's going to hold you through. So,
Yeah, I definitely think as the equity the returns for equity investors will trounce every other asset class over a lifetime. I think that's just maths.
yep.
Um, the magic of equities is that they produce something and then they can also take that production and then the compounding process can happen. They can reinvest it. So that's really the genius of equities. But the price we pay as equity investors is that several times in our lifetime we will have very large drawdowns, and that's just the price you pay
Hmm.
for participating in this wonderful game.
Yes. Okay. So yeah. So sounds like you're pretty much set in your ways here. Do you see your process evolving over the next couple of years, or you think you're going to stick with this for 5 years, or you're going to wait and see, or what are your thoughts on that?
Ideally, I'd like to stick like this forever.
Yeah,
Wouldn't like
yeah.
to sell any of my companies and they all just go up, but I don't think that will happen.
Yeah,
Yeah, I think the general framework is always there, but as in the people who have been successful over multi decades
mhm,
have found opportunities in different places over time, and so that's fairly well documented with Buffett.
yeah.
Started off as the net, special sits, control situations, and then sort of migrated ever so slowly to the better quality companies, and he kind of was doing preferreds and
Mhm,
then whole acquisitions, and then gets all these like sweetheart deals because he's America's grandfather or something like that now.
yeah,
So and so I think the North Star of the value investor is to go where the value is. And that might be in unusual places. But I think those kind of first principles will kind of stay the same. But over a lifetime, I feel like the business environment today is remarkably different than it was 20 years ago, and
mm,
probably remarkably different than it was 40 years before that. So got to keep learning, keep moving.
that's right. Yeah, yeah. So, well, it sounds like you're open to something. But yeah, if you've got that basis there that you I don't think you need to look too far. If you can understand quality, I don't think you really need to look that far. You just got to hold through. Um, yeah, so that's all I really wanted to go over. Yeah, where's people can best follow you online? And I know you are really active on Twitter, but crazily amount on Twitter. Like that just blows my mind how much work you put into that. But I see you started a Substack as well. So where would you like people to
Yeah,
follow you?
no worries. So you nailed it. Yeah, I'm on Twitter at Larry Jamieson underscore, and the tags Buyback Capital. And yeah, there's a Substack. Substacks of the same name, and you can find me. There's a link on my profile. And yeah, there's a YouTube channel. I try to put out some videos when I can. I haven't been as disciplined on that lately because life gets in the way. Um, but yeah, that's pretty much where you can find me. My Twitter is not for the faint of heart, so it's not PG. And yeah, Twitter's a battlefield, so
Yeah, 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 yeah.
come prepared.
Yeah, yeah. It's very entertaining. I'm just like, wow, this guy's like into so many areas here, and some wonderful people like on Twitter, and yeah, some of the conversations you're
I
having on there.
I gotta tell you, Twitter is like the most magical platform on the planet. Like it's the only place where a 20-something-year-old living in Queensland can interact directly with where the CEO of a large publicly traded company
Yeah,
would reach out to you.
I know.
Like
It's
it's a
just
magical forum.
yeah, and it's great that you see you're doing well. And that 7,000 followers is just for an under 30, who wasn't educated in finance, who's like out there swinging it with the big boys. Yeah, it's really good to see. Yeah, so I just want to thank Larry for his time. Yeah, much appreciated having you on. Yeah, I'm looking forward to seeing what you're going to do over the next couple of years. Um, hopefully, it's not as eventful. Like, your quality investor is supposed to be very boring type lifestyle. So hopefully
Well,
that.
ironically, Brisbane is I've been told is like the Omaha of the Southern
Ah,
Hemisphere.
okay.
There's a couple of interesting guys. There's a the Gaines Fund. I forget what the gentleman's first name is, but he's run a pretty long dated value quality fund. He lives in New Farms, a
Yes.
few blocks down from me. And yeah, there's a couple of other guys like who live around Macrobat and stuff like that are here. Don't get out to see them, but apparently we're in the Omaha of the Southern Hemisphere. So where
Yeah,
else would you
yeah.
want to be?
I know, yeah, it's just nice to see someone local, really giving it a shot. And so what are your plans in the future? Like have you thinking of fun? You think you're gonna move into finance somewhere here, or what are you thinking of doing with your knowledge here? You're just gonna run private money here, or what are your goals
Yeah,
for the future?
yeah, I think finance is a really great hobby, but it would probably be a, not a very fun profession. I haven't worked in it, so I don't really know. I do think a lot of my friends on Twitter who live in New York or around New York, and some of my friends who live down in Sydney, um, they're very interested in things that I just don't care about, like um, they're very interested in what everyone's comp's going to be this year and what their
Oh,
bonus is going to be and
okay,
the
yeah.
car and
Uh-huh.
I just couldn't care less. So I think the gentleman from the Gaines Fund, he's figured out he gets to live in Brisbane and run some money for his family and friends, and I think that's maybe an aspirational goal
Okay.
down the line. But I really enjoy what I do for a job, and I like being able to do this as a hobby. It's a lot of fun. It's a good life.
Yep. Oh, well, I think you got the right attitude there. Yeah, trying to do it as a living, I think, quarter to quarter, I think would be fairly nasty. So, yeah, I think that's great. And yeah, I just want to thank you again. And yeah, I'll put some links below where you can follow Larry. And yeah, appreciate it, mate.
Thanks so much for having me. This has been a lot of fun.